What if I told you that you could become a millionaire by investing just $500 a month? And no, this isn't some crazy get-rich-quick scheme or a dodgy pyramid operation. It's a tried and true method that's been working for decades. And you might be thinking, Felix, I can barely afford my Netflix subscription. How am I supposed to find $500 a month? Well, stick around. You see, while most people are busy chasing the next hot stock tip or trying to time the market, the truly wealthy are playing a different game altogether. And today, I'm going to let you in on their secret. Even Winston here sniffed out this research, and let me tell you, it's absolutely fascinating. We'll dive into the numbers, break down the strategies of millionaire investors, and I'll show you exactly how to discipline yourself to find that $500 each month. And the best part, you don't need to be a financial whiz or have a trust fund to get started. So if you're ready to learn how to build wealth like the top 1%, then let's dive straight in. And maybe you think stocks are for the rich, Felix, but hold on to your hats, because this might just blow your mind. Did you know that the main difference between the wealthy, we're talking the top 1% here, and the average Joe isn't just their fancy cars or massive mansions, is how they invest their money. The top 1% of US households have 60% of their net worth invested in stocks. Now compare that to the bottom 50% who have only 4% in stocks. That's a staggering difference. Now let's talk about the S&P 500. For those of you who aren't familiar, it's like the all-star team of the 500 largest US companies. And it's been performing. Over the last 30 years, the S&P 500 has returned about 10.5% per year on average. Not too shabby, is it? Of course, past performance doesn't guarantee future results, but it's a pretty solid track record. While you might think keeping your money in a savings account is playing it safe, you're actually losing money in the long run. Why? 2 words. Inflation. Well, more like 1 word or 3 syllables. That dollar you had in 2000, remember 2000? It's now worth 50 cents, literally. You lost $50, 50 cents off that dollar. It's like your money is on a crash diet and not in a really good way. So while your savings account might be inching along at a snail's pace, definitely not keeping up with inflation, the stock market has the potential to outpace inflation and then some. If you want to build serious wealth over time, investing in stocks should be a key part of your strategy. It's exactly how the wealthy stay wealthy, and it's how you could potentially join their ranks. So now that we've crunched the numbers, let's talk about strategies. What do millionaire investors know that the average person doesn't? Well, thanks to a fascinating study by Vanguard, we've got some rather good insider information. It turns out millionaires aren't out there day trading or chasing the next hot stock tip. In fact, their portfolios are surprisingly boring, and that's a good thing. The Vanguard study found that the average millionaire investor has a significant portfolio in stocks, with a focus on broad market exposure. That is exactly where our S&P 500 strategy comes into play. Now, long-term is key. We're talking years, even decades. In this case, it really isn't about timing the market, it's about time in the market. The longer you hold, the more you let compound interest work its magic. Now, here's where the S&P 500 tracking funds such as SPY really shines. When we talk about diversification, the S&P 500 is sort of the ultimate diversification tool. It's not just one stock, it's 500 of America's finest companies across all sectors. So by investing in a simple S&P 500 index fund, you're essentially buying a slice of the entire US economy. You've got tech giants, healthcare companies, financial institutions, consumer goods, you name it, it's in there. Diversification on autopilot. And it does 2 things for you. It helps protect against major losses if one sector takes a hit. And it positions you to capture gains across different parts of the market. Sort of a win-win. And maybe you're thinking, sounds good, Felix, but what are my chances of actually succeeding? Well, I'm glad you asked, because the numbers are encouraging, I'd say. If you invest in a diversified stock portfolio, just like the S&P 500, if you hold for 10 years, your chances of a positive return are about 88%. Extend that to 20 years, it jumps to a whopping 100%. So statistically, historically, if you just owned the S&P 500 over 20 years, you would have made money. So remember, invest in the S&P 500 for the long term, enjoy the built-in diversification, and stay the course. It's not about getting rich quick, it's about building wealth steadily over time. just like the millionaires did. In our next segment, we'll dive into some key principles that will help you succeed in your investing journey. So you might be asking yourself, well, how do I get the discipline to save $500 every single month and put it into something terribly boring like the S&P? Might sound daunting. Well, it is entirely doable. So let's break it down. First things first, you need a clear financial goal and a timeline. In our case, it's becoming a millionaire in 30 years. Write it down, stick it on your fridge, tattoo it on your forehead. Well, you don't have to do that, but you get the idea. And then create a budget. Oh no, they're boring, Felix. Don't make us do it. You want to track what's coming in and what's going out. For most people, what's coming in is fairly simple. It's typically 1 or 2 salaries, and that's about it. And maybe I'll talk a little bit about that in a moment. But you might be surprised where your money is actually going. See, it's often the little expenses that add up. A choo-choo here, a fancy coffee there, and before you know it, you are hundreds of dollars out of pocket and you don't even realize it. Subscriptions are one of those things. We tend to subscribe to stuff and we forget about it. Now, if you go through your credit card statement every Monday or every Sunday, which is what I do, then you notice what those things are, because you were like, who did I pay $12.99 to? I don't remember what that was. If you do that every week, I can guarantee you, you will find hundreds of dollars in just pure waste. It will not lower your quality of living. It will not affect the way you enjoy life. You will just have more money. And then there is the real golden rule. Automate your savings. Actually, I shouldn't say savings, your investments. Set up an automatic transfer of your $500 to your investment account the day after your paycheck hits. It's like paying a bill, except the bill is to your future millionaire self. And then, yeah, let's look at the expenses that you are not getting a real joy out of it. Do you really need that premium cable package or whatever it is that you get? And maybe you want to cut down on the avocado toast habit. Apparently it's doing terrible things to the rainforest or wherever it grows anyway. The way I look at expenses is I like to enjoy my life. I think life's reasonably short. We want to enjoy every day of it. But there are things that we do out of habit that don't spark joy, as some weird old TV tidying expert once said. And I think there is a lot of truth in that. Just look at it and go, does this really make me happy? That thing I just bought. And if it doesn't, maybe you can cut it out. And then you can say, well, I think being a millionaire is going to make me happy because I know I'm going to have a really, really good life. And I know I'll be able to quit my job and, enjoy the things I've always wanted to do. And if you're still struggling to hit that $500 mark a month, consider a side hustle, dog walking, freelance writing, renting out a basement room or whatever it might be. And in all seriousness, I think a great place to go is upwork.com. I think you can get the highest salaries there, if you will. I've hired people on Upwork and I pay them anywhere from, I'd say, $35 to $400 an hour for all sorts of bits of expertise. And you probably have some expertise, some hobby you have, something you do for a living, something part of your job. And you could share that expertise with small and medium-sized businesses out there, hey, even large businesses out there who would value that input maybe for a couple of hours a week. And you might actually enjoy it. It might actually be fun. And you might actually find yourself moving from your full-time job and to just doing that. That would be a wonderful thing as well, because you're now in control. You decide what jobs you take. It's a big step up from being a wage slave. The principle that served me well, pay yourself first. Treat that $500 savings like it's the most important bill. Pay it before anything else. And then visualize your progress, because that can be a huge motivator. You can use an app or some website or a chart or something, and you can watch that number grow. And it's sort of like the motivator. So I have a chart on my wall where I have my targets for how much I add every Monday to my portfolio. I like to do it weekly. Of course, you can do it monthly. And it's insane because I know what that number is going to look like in 10 and 20 years. And that's kind of what makes me smile. And it actually becomes almost like a computer game. It's just fun. Now, if you struggle with doing it, find an accountability buddy. Team up with a friend or a family member who's on the same wavelength as you, and encourage each other and celebrate milestones. And look, for some people, I get it. Saving $500 a month isn't easy. There'll be times when, you want to skip a month or you want to give up entirely. But remember why you're doing it. You're not actually saving money, but you're building a future where financial stress is a thing of the past for both you and your offspring. And every single journey begins with that first single step. In this case, it's a single dollar. Start today, stay consistent. And before you know it, you'll be well on your way to that $1 million goal. There will be some challenges on the way, though, that you're going to face. Because if there weren't, everybody would be doing this. And they're not. And what is it? Well, number one is market volatility. It's the financial equivalent of a roller coaster, and it can be stomach churning. You will see your investment will go up and down, sometimes dramatically. And the key is to remember that those ups and downs are normal. In fact, it's what creates opportunity for long-term investors. When the market dips, don't panic, don't sell. Instead, think of it as all your stocks going on sale, and your $500 investments that month will now buy you more shares because prices are low. So you're going to get bigger gains when the market recovers, and recover it shall. And one thing I found is the most important from the 12,000 students or so I've worked with over the years, it's motivation. There'll be times when progress will seem painfully slow, especially in the early years. There's a lovely Charlie Munger quote which goes as follows: the first 100K is a bitch. And he's right. It just feels like, it's just such hard work. But remember, compound interest is working its magic behind those scenes. Those small, consistent investments every month are laying the groundwork for explosive growth later on, which is why I would encourage you to have that chart on your wall. So to stay motivated, celebrate small milestones. Every $10,000 you invest, for example, is a victory. Every year you stick to your plan is a triumph. So celebrate those things. Visualize your progress, track it. Seeing that line graph tick upwards, even slowly, can be incredibly motivating. And now we need to figure out what we do when life happens, because sometimes you need cash now, right? The key is to build an emergency fund alongside your investments. I'd say 3 to 6 months of living expenses in a easily accessible savings account might be pretty good, because that way you won't have to dip into your investments when you have an unexpected cost. And trust me, you typically get those when the market's just crashed. And at that point, selling is painful. And if you absolutely must use some of your investment money, try to replenish it as soon as possible. Because remember, every dollar you take out is potentially hundreds of dollars lost in future growth. And lastly, you will have life changes. You might get married, you might have children, golden retrievers, who knows, change your careers. Your financial plan needs to be somewhat flexible and adapt with you. So review that plan annually. Do it as a family, seriously. Do it with your partner, do it with your children. Golden retrievers help a lot, I find. And if you're all on the same path and understand where it's going, it'll be much, much easier. And you get better ideas. And you'll also teach your children how to actually become financially free. And remember, it's going to be a lot easier for them because they'll have you to support them with your millions. So the plan here isn't to stick rigidly to the plan you made 30 years ago. It's to be committed to the principle of consistent long-term investing. And then you adjust the details as needed to suit you. Right, so we're on the home stretch, but before we wrap up, there are a few additional considerations we need to touch on. And they could make the difference between good results and great ones. First, let's talk about Uncle Sam. Taxes. I know, he wants us cut. So when you're investing for the long term, tax efficiency can significantly impact your returns. Consider using tax-advantaged accounts. If you have a 401k, use it up to the point that your employer matches your contributions. Don't go beyond. It's not a good tool. I would suggest a Roth IRA. Of course, I'm not a US tax advisor to talk to somebody, but they help you not pay taxes on the gains. And once you understand that most of your wealth is going to come from gains, not from you putting the money in, it's much, much better to pay some tax now, but not pay tax on those gains. Remember, we want to balance present enjoyment with your future wealth. Yeah, we want you to become a millionaire, but not at the cost of living like a hermit in a dark basement for 30 years, because you might not make it till the 30 years in that case. You got to find the right balance. You got to budget for some fun. You got to budget for some travel, for some celebrations, while still prioritizing your long-term goal. The key is to make those treats intentional and planned rather than impulsive splurges. And as you get to your goal and exceed your goal, you will have a lot more freedom to be more impulsive and enjoy things more and more and more. There are a lot of fun things you can do in your life that don't necessarily cost a lot of money. The things I enjoy the most are literally just going into the mountains with my friends and dogs, and we'll take a picnic along. It doesn't cost the earth. Probably a lot more fun than a 3-star Michelin dinner in some stuffy French place with a snooty waiter. So it depends on what you enjoy. If there are certain things in life that you really, really, really get a huge kick out of, do them. Just appreciate them for what they are, and make sure they're part of your budget. So let's do a quick recap of what we've learned about becoming a millionaire by investing just $500 a month for 30 years. First, we saw the power of investing in stocks, particularly through the S&P 500, which has historically returned 10% plus annually. Second, we broke down the numbers and showed you how $500 a month can grow to over $1 million in 30 years, thanks to the magic of compound interest. And third, we explored how millionaire investment strategies emphasize long-term holding and diversification, both of which you get with an S&P 500 index fund. And fourth, we discussed how to discipline yourself to invest that $500 a month, from budgeting to automating your investments. And finally, we looked at some common challenges like the market ups and downs and how to stay motivated when progress seems slow. Now, here's the most important part. It's time for action. Your future millionaire self is counting on you to start today. You see, Winston here, he doesn't just dream about chasing squirrels. When he sees one, he goes for it. And that is exactly what I want you to do with your financial future. Your first step, open an investment account if you don't already have one. Look for a brokerage that offers low-cost S&P 500 index funds or ETFs. We made a video on brokerages. You can find one in there. And then set up that automatic monthly transfer of $500. Remember, pay yourself first. You are more important than anyone else out there, you and your family. And remember, you're not alone on this journey. I'd love to hear about your experiences and questions. Drop a comment below and let's keep this conversation going. If you found this video helpful, please give it a thumbs up and share it with somebody who could benefit from this information. And don't forget to subscribe to our little educational channel here. And I wish you tremendous success.